Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Friday. Thank God it's Friday. It is December 3rd. What a week, right? What a week in the market. Talk about volatility. The interesting thing about it, and by the way, it's about 7:42. Market's going to open up in about an hour and 40 minutes or so. As you can see here, today's very different from every other day we've seen this week. The market's actually flat. Imagine that. Go figure, right? I mean, look at this. Just nothing going on. Very, very random. Not even random. Just a nothing burger. Today we have employment data. Yesterday we had jobless claims. Came in at 222. Absolutely uneventful. Today we have employment situation, factory orders, ISM service index. I'm expecting for the most part the numbers to be in line with estimates. And the truth to be told, this Omicron is what's driving this market right now, not anything else. Looking at momentum levels, and I wanted to show you guys momentum levels. This is a daily chart. This is a 2-year chart. This is as far back as I can go on a daily basis. And if you look at the number of stocks trading above the 50-day moving average, it looks like we're near the bottom. It looks like we bottom. Matter of fact, if we go a little bit higher up here, I don't know why we were so low, but if you go to about the 23rd percentile, it looks like we already turned up, and it looks like we're going higher. So I think momentum levels are going to go higher on the number of stocks trading above the 50-day moving average. Right now it's 42, which means the market is actually slightly bearish. If we look at the market as a whole, let me just show you this. As you can see here, we're literally right at the 50-day moving average. Now, here's the interesting part. If you look at the Dow Jones is doing the same thing near the 200-day moving average. The reason you're seeing such a big divergence in strength between the S&P and the Dow is because the S&P 500 has been getting a lot of love from the NASDAQ 100, which is the chip stocks. Notice they're not even at the 50-day moving average. So if you look at the strength of each individual sector or index, you would have NASDAQ 100, S&P 500, which is a mix between the tech and the blue chips. Notice it's lower. I'm just trying to give you guys a good dynamic of where we're at right now. And then we have the Dow Jones, which is even lower than that. So blue chips are taking it under the chin, but chip stocks and tech stocks are still promising. I personally believe we're going to see an undoing of that. I think we're going to see market capitalization come into the blue chip stocks and away from the tech heavy stocks, because I believe economy is going to get better, not worse. And if you look at the put to call ratio, it's actually not that bad. It's actually pretty random. It's coming off of those overbought levels that we saw, which means the market is not as exuberant to the upside or the downside right now. It's kind of in the middle, which means we shouldn't have too much volatility. Speaking of volatility, this is the VIX, and as you can see here, it looks like it spiked, and it looks like we're finally moving lower. So what I'm expecting for next week is lower VIX, higher. Here, let me show you this. Let me go to the bond market. The bond market to start turning lower and coming off, and Dow stocks to start coming higher. I'm very nervous about tech stocks because I think tech stocks are going to see more of this, and blue chip stocks are going to go higher because we are on the oversold territory right now, and there's no major catalyst right now to cause the market to go lower. Especially with the Fed lowering rates. The Fed has their foot on the gas pedal. That's the bond market. And if the market's going too low, they'll just say we're going to slow down the bond purchasing, and the bond market will stay near the current level. I believe the market is overbought right now, as you could see here based on the RSI, and I believe it's going to be turning lower. In addition to that, we are seeing a nice little divergence in the bond market, which usually leads to a change in the trend. So this is very similar to what we saw the tech sector before we turned. And as you can see here, higher prices, momentum levels can't keep up, and typically that means the rally fails. So I'm expecting bonds to go lower, volatility as measured by the VIX to go lower. Again, I'm just kind of going through the entire analysis, and the stock market to start regaining its value. Now today we've got employment data. Again, unless the number's really, really bad, the Omicron, the big O, as I call it, as someone gave me a good tip to call it, will probably override all fundamental data. Speaking of Omicron, let's talk about world economy and see where we're going to go from here. because there's a lot of stuff on the table. Employment data, other data due Friday, that's these reports. Again, I'm just kind of trying to interactively show you what and how, kind of give you a show and tell. So that's due out today. And again, the data is going to impact the market, but the overriding concern is this Omicron. Concerns over the spread of the new COVID variant and measures governments are taking to restrain it remained, but appeared to have been assured, I think they misspelled assured, or assumed by reports that its symptoms seem to be mild and vaccine appeared to protect against severe illness. That's the stories that I'm hearing. I'm not hearing that it's that bad. China, more news with China, but again, Omicron is overshadowing China. But Hong Kong trader developer Kaiser Group, it failed to get required approval for bondholders to extend its deadline, $400 million, 6.5% offshore bonds. It had wanted to have new notes by June 6th at the same rates. That means raises risk of default. Not good for China. Rally comes as investors, the rally that we had yesterday in the market comes as investors try to gauge the amount of damage the Omicron variant of COVID and measures the U.S. and governments are taking to restrain it might inflict on the economy. So far, things are looking good, and the Fed is acting, they're just putting their head under the sand. We're going to increase the curbing of bond buying. I mean, they're just acting like it doesn't exist. So far. Countries have been imposing barriers to travel and stricter restrictions on business and people. Concerns about global restrictions potentially crimping economic growth joined worries over rising inflation, which has prompted the Federal Reserve to consider withdrawing stimulus measures sooner than expected. So again, they've been behind the black ball on that lately. Crude oil prices, yeah, Biden's attempt to wrestle with OPEC didn't do much good. U.S. crude oil prices rose after OPEC and allied oil producers countries decided Thursday to stick to their plans to boost output via steady, modest monthly increase in oil releases, even as the Omicron variant adds more uncertainty over the global economic recovery of the pandemic. So oil is fairly stable right now. Now, I want to show you guys a trade we took this week that worked out really, really well before we get into next week's prognosis. Prognosis, I like that word. It sounds like I'm a doctor. So we shorted Pinnacle West Corporation. This is what kind of a stock is it? Let me take a quick look. Utility stock. And utilities was the last or the weakest sector, and communication technology. So we got into this stock. We sold it a little early. We sold it on the 17th right here. We had a little drawdown, hit the 50-day moving average, came off. We got rid of it on the 30th, which was right here on this date. Let me do a close-up for you. So we got in right here on the 17th, rode it for a few days, got out of it right here on the 30th, kind of at the same price it's at right now. Nothing really major. The stock made 2.66%. The option made 42.11%. Not bad, right? And we held the position for 13 days. That's including weekends. So, 11 trading sessions. Our average is about 7.7, give or take. But again, I just wanted to show you a short trade that we actually made money on this week. And if the market rallies today, I'm going to be closing Procter & Gamble and a couple of other stocks today. But you'll get that info if you're in my session. Now, as far as the broader market, here's what I'm thinking. Here is Roger's point of view. I like that, Roger's point of view. I think the semiconductors are going to continue breaking down a little lower. I think they're going to break this level. If we see them break the 3,732 level, or on the SMH, which is the actual tradable asset, if we break the 297 level, I think we're going to continue going lower all the way to the 291 level because there's just not much support here. And I think that chip stocks is what's holding up this NASDAQ QQQ quite a bit. There's a lot of chip stocks in the NASDAQ. And once that happens, we're going to go lower. But I believe the Dow Jones is actually more bullish now and is going to start rallying. So I'm increasingly bullish in the blue chips, and I'm becoming more bearish in the tech. Now, put the call ratio, as I mentioned, it's kind of random. There's nothing much going on, so I'm not expecting extreme trading action. And if you look at the VIX looks like it's about to go down, as I mentioned earlier. It doesn't look like it's going up. It looks like it's going down. So there's a really good chance we may be able to get out of this on the right side of the market. as far as stocks you guys need to pay attention to, market breadth is not really there. We're only seeing 83 stocks breaking down 90-day low, 24 stocks making 90-day highs. It doesn't look like there's a lot of things out there. Now, looking at the 11 major sectors, let's see if we have some fragmentation. Still, technology and consumer discretionary are leading. Consumer staples and utilities are apart from each other. Basic materials are industrial are apart from each other, which means the market is still rather fragmented and may take us a bit of time to get out of there. But with that said, I'm not expecting too much choppiness, or I'm not expecting too much volatility. Maybe some choppiness, but not a lot of volatility. Now, in terms of the stocks that are rising right now, NVIDIA, Advanced Micro, I like these stocks. These are chip stocks, but I think they're going to start cooling off. I prefer the energy stocks, the Enphase, the Devon Energy, the Monolithic Power. I would be cautious right now with the chip stocks. I would be very, very cautious with the chip stocks right now. Extremely cautious. Medical stocks I like. I like pretty much anything except chips. I'm a little cautious on chips right now. And in terms of the weakness, Gap, Penn National Gaming, Norwegian, Dish. Remember I was telling you how much I don't like this stock, Carnival. Back to the COVID environment where Carnival and the cruise ships didn't do so well. Las Vegas Sands. Basically, the bottom line is we look like we're having another major, or we had a nice little shakeout. Again, I just wanted to tell you guys what's going on. Next week, expect less volatility and more directional bias, and I think the markets are going to start cooperating a little more with us unless we hear more negativity regarding this Omicron. I think things are going to get better and stabilize. And if we find out that it's the truth that people aren't dying from it, well, it's just not going to be it's going to be a nothing burger. So that's the overriding concern. Keep your eye on volatility. Keep your eye on the put to call ratio. Keep your eye on my momentum levels. And as I showed you, momentum levels right here. There's 42% of stocks trading above the 50-day line. There's not a big divergence between different indices right now, but on a daily basis, I think we're close to bottoming out, as I will show you right here. See that? Maybe a little bit more, but we look like we're pretty close to bottoming out. I'm just not seeing too much more downside. This looks like a major shakeout right here. That's the COVID downside. But typically when we have a nice shakeout, we don't go past the 23, 24%. That's why I'm expecting the market to start moving maybe a little bit lower and then a lot higher from the current levels. It actually looks easier when you look at it on a line chart. There it goes. You could see it. So I think we're near the lows on the momentum on the blue chips, and I think we're going to rally. But keep your eye on this Omicron, the big O. Now, I've got something important I need to tell you. Folks, there's never, and I mean it, there's never been a better time to know what's going on in this market and have a plan of attack to trade it. Now, today, I'm opening up my VIP Champion Trade Room to anyone who wants to join us today. It starts at 11 a.m. Eastern Time, and here's what I'll be covering. What the Omicron variant means for certain stocks and sectors, how I protect my portfolio from surging volatility, my buy and short watch lists. You need to see the watch lists. A critical update on market momentum levels, stocks I'd avoid with rising rates coming this year, and much, much more. Now, make sure to save this link below this video, enter the room before 11 a.m. Eastern Time, and I'll see everyone there. I'm going to give you a full hour of my analysis today. You can ask me any questions, and I'll be there for you. We've closed out on my discretionary trades. We have an over 80% win rate right now. I'm going to show you all about it, give you the spreadsheet so you could look at it, and get you guys on the right side of the market. And lastly, follow the link below. Check it out. I'll see you there, 11 a.m. Eastern Time. Don't miss out. It's happening in 9, 10, 11, 3 hours. And as always, make sure to like this video, subscribe to this channel if you're watching on YouTube. Stay ahead of the market. Watch my videos. Follow the subscribe button if you're watching on YouTube. Bye. Have a great weekend if I don't catch you at 11 a.m. But I hope I will, because I've got a lot of goodies for you. Bye.